Okay.
So yeah, our Ruoff agent app that you can download has all the milestones on it. They can do the digital application. You all can refer directly from it. So if you have a client that's looking to buy, if you refer to that app, you'll automatically send them the link to start filling out that.
It's called Ruoff Agent. Ruoff
Yes.
Agent.
Yeah, there's 3 apps, one for us, one for the client, one for you guys. The other thing is we have a step ahead program that allows us to fully underwrite a file and pre-approve it. And instead of getting a letter from me or him saying, hey, you've been pre-approved, you actually get a letter from the underwriter themselves saying, I've underwritten this file. All we need is appraisal title and we're done.
It basically makes it become a cash deal. So I've done one this year, got a clear close, and it's clear close in 10 days.
Yep.
So we got the deal done in 2 days. And the client was like, man, I've looked at so many houses, I can't get one. I was like, let's do the step ahead. That we maybe, we'll get it done. And the reason why they took it was the agent called me. He's like, you get this closed in 14 days. And I was the first one I done. I was like, let's try 18. But we got it done in 10. So it was one of the reasons why we're going to do it. And then the app also has on there our marketing button. So we have over 1,000 pieces of marketing that are free for agents. So you guys can go through there. And you can also look on, you can just go to our website. Once you sign up there, you can go to the website, look at it too. You go through there, you just click on there. Once you sign in, you'll pick a lender that you want to be your kind of contact. So there'll be a button on all those pieces that say I'm interested. So there's open house flyers, there's rent versus buy, there's all the things you want. They're all free for you guys. You just hit I'm interested in, it'll email whoever you say your lender is. We'll gather your information, send it to our marketing department within 24 hours, 48 hours, we send it back to you. And if you want to, generally it's one of our preferred realtors that use this, we'll print about 4 if you want, but let anybody use it for free. So it's a great tool. There's a great mortgage calculator on there. So it's good to have it, because also you'll take, you're going to take Ruoff letters. They just let you know exactly where you are throughout the whole process, and it keeps it running for you. So once that referral sent, like I said, it takes 10 minutes to fill it out. 5 or 10 on the phone with us. Once we do it, we get it in there, and then we just see if they're where they are in the whole process. We fill out the application. Once the application is a few things left before we shop for houses, just upload some documents, and it's really because of the new contract. We don't want anybody to lose any money. So before, we could kind of tell who was a good buyer, who wasn't a good buyer. We wouldn't always get all the documents up front. We as a team and Ruoff in general, we're going to gather those things. So before we give you a pre-approval letter, we used to give pre-approval letter. We don't want you to go out to shop unless it's because COVID has made it so much more difficult to calculate income and the different types of income now. We want to make sure that we're all on the same page and that you guys actually have a good pre-qualification, like you said, so it does take a little bit longer, but those documents through their app, which is the Loan Buckler app, they can take pictures, or if they have it on their phone or in there, it automatically goes into the app and comes to us directly. There's no scanning, there's no input, and it goes into our system that we need it to. So it's completely secure and just saves so much time, and it's readily available for any time. Those documents: driver's license, photo ID, last 2 years, tax returns, W-2s, pay stubs, 2-year consecutive months of complete bank statements, and whoever you guys want to kind of use for your homeowners insurance, but we really don't do that. That's something we have that we start to look for. But so all this really, if you had to go through it and upload documents, and anybody that's pretty savvy, it takes an hour, hour at a time. But it gives us so much information that we'll get into to save them money. Because they also think that it costs to get pre-approved, and really it costs $0 to be pre-approved. We don't charge anything.
Actually, I had a client ask me the other day, how much does it cost to get pre-approved?
Now, even like if we pull credit for people, they don't ever buy. They wouldn't charge for the credit. So it's kind of one of those things we eat now. If they do get a house, there is a credit pull for those people that do the house. It's just part of it. But there's no cost. And I've worked with people over a year before getting their credit rating or getting new service, sending pre-approval letter after pre-approval letter on weekends and nights, whatever. They're like, how much I owe you? It's what I do. It's part of our job. And with Ruoff too, we have such great technology. We can do all that stuff. I play a lot of golf. My kids are all grown. So I said it takes me 5 minutes to send a pre-approval letter, update pre-approval for my phone. or do anything. I can look at numbers, I can do certain things. Ruoff gives us all the tools we need to do those things. He's got young kids and he kind of does the same thing.
Yeah. I'll be at home and they'll be out playing outside. I'm sitting here working on my phone, just like. They're yelling, dad.
So yeah, it doesn't, no matter how many times you guys call or the client calls or updates, what's this look like? What's it look like if I put $5,000 extra down? What about 10,000? We get that like in every increment, they want to see it. And we tell them it's not that much more, but they really want to see it. But we can do it all from our phone. So it doesn't take any time, but we'll never charge them for it. In the long run, it actually ends up saving you thousands of dollars to get pre-approved early. And we'll go through those steps of why we can save our money and how we save our money. Let's look at, this is a huge one for me. Like until I got in this industry, I did not understand how credit works. Credit and how they report credit is the dumbest thing in the world. Until you kind of understand it, it kind of starts to make sense. But these are the two big hurdles we get when it comes to credit. Another lender's already pulled my credit. I don't want you to pull it because I don't want my credit score to go down. Or Credit Karma says my score is. And that one is just the funny one because Credit Karma is terrible. Another lender has already pulled my credit. So what a lot of people don't understand is that if another lender has pulled your credit in the last 45 days, your credit score's gone down 1 point. You can then have your credit pulled an unlimited amount of times through another mortgage bank or originator looking at pulling for mortgages because the government, they want you to buy a house. They don't want to penalize you for it. So for that many times, you can shop and have it pulled as many times. It's not like buying a car. You know, when you go to a car dealership, if they call 5 banks on behalf to try to get you a loan, that's 5 points. If you go to the next dealership down the road, they call the same 5 banks. It's another 5 points. You've lost 10 points of your credit score. It's not like that in our industry. So it doesn't hurt them. I would suggest that you have them shop. We tell our clients, like, if you want to shop, that's fine. Because if they can beat us, they can beat us. But we all kind of, what you say, work with the same.
Yeah, well, I was telling somebody, we all have the same, I was compared it to a chessboard. My kids are really into chess, right? We all play with the same pieces, it's just a matter of how you play with those pieces. So, I mean, you can get different outcomes because you made different moves, but ultimately, we're all playing with the same pieces.
Yeah, so it all boils down to the same thing. It's just about getting the client best, and getting them ready for that. So having them understand that they can shop and it doesn't hurt their credit. You know, the other one is Credit Karma says my score is. Credit Karma's wrong. And the reason why they're wrong isn't because of any malicious reason. It's just they have a different score than we use. They have what's called a Vanguard score. It's a 2-year snapshot of just what you've done in the last 2 years of credit. So in the last 2 years, if you've worked on your credit getting better, your credit score is going to be a little better than it should be because if you've had things that were bad previous to that. Then vice versa, if you have really good credit, and then for some reason last year you missed one payment, and for any reason, it's going to say it's worse. But it's always 30 or 40 points off of a FICO score. FICO score is what we look at. It's your entire credit history. From the first time you went to Daytona Beach and signed up for a credit card, get that free t-shirt. That's when it starts. All the way up. What I did with my kids. I didn't do that. Yeah. That's why I have such a great Discover rating. What I did for my kids was as soon as they turned 18, I opened a credit card name and did not get it. And then I would use it to buy a can of soda, a tank of gas, pay for it. And then, you know, over the next couple of years, by the time my kids were in their 20s, they all had to meet up the credit scores. So it just, that's where it starts, is building that credit. So that's why they look at it all the way back to see if you've always been responsible or not. So that's why we want to pull their score and see actually what their FICO score is. Because there's ways to save money there too that we'll get into. Yeah, so this is actually how credit works. When we talk about credit, I found this and loved it. The amount owed, your new credit, length of credit history, credit mix, payment history. That's how they all figure it out. So if you have 5 credit cards and we hear this a lot, hey, I'm going to pay these things off. Talk to us first, that way we can tell you, because all these have different factors in there of how they'll correct your score. And you might think you're doing something to help your score that actually hurts it. So we'll talk about that here in a second of
and the deal that I just recently got to, the previous lender told them to pay off a collection, and that is not what you want to do. Paying off collections can actually hurt your credit if they're past a certain point. because it reactivates a recent credit history on that negative credit. And so she was like, yeah, we set up a payment plan with them. I'm like, dang it. Well, don't do it anymore.
Well, I tell people, and some people just like, if you have a collection, your client has a collection that's over 6 months old, or if you have one, your kids have one, it's over 6 months old, don't ever pay it. And if it's under $2,000 and it's over 6 months old, don't ever pay it.
Yeah.
It'll fall off eventually, but paying it will not help your credit score whatsoever. I had a client say, hey, been waiting 4 months to call you because the realtor said to call you, but I had like $3,500 worth of all these little bills and collections that I wanted to pay off first before I called you. And I was like, please tell me you didn't pay them off. She goes, I paid every one of them off. Credit, and they were still on there. And then we have a calculator that forecasts what you do when those happens, and you pay them all off. Score 1 0. That's wasted $4,500. So that's why we say, you know, I'm not ready to buy is a big thing, but getting pre-approved gives you the roadmap to buying if you aren't ready to buy for months, because credit's part of that. The first big thing they have is we do the credit check. You know, you want to know your optimal score. You need time to get your score up. Increasing your credit score can save you thousands, and we can see what debts may need to be paid off in order to get your score up. The big thing about that now is since COVID, it used to be anything, your score was 720 and above, you got a pretty good rate. 740 got a little better. 760 to 850 are perfect. It was about the same. It's not like that now. 720 is not a very good credit score. Is not
Not as good as it used to be.
Not as good as it used to be. So now you need to get to 740 to be okay. 760 and up is a huge, that rate is generally a quarter better than 740. You're probably another eighth or quarter at 720, and then at 700 and below, you're talking a half a point. So it's tremendous. So letting us get them pre-approved and looking at the credit score, what we can do is we talk about, all right, you have these collections, or you have this, you have that. Early in my career, I got somebody's credit score of 100 points in 45 days. And it was opening a secured credit card, which they took $200, got their own credit card. And then they took their own, just basically $200 to open the card. And then they were an authorized user on their mom's account on the card that was maxed out. Took that off 30 days later after that first one posted, 100 points. That 100 points saves thousands of dollars.
So what is the best way to navigate credit? You know, husband and wife partnership buying, right? Their credit scores are significantly different perhaps. How does that use the worst credit score? I'm assuming what ends up being required to both applying together. You then maybe interested to take off the low credit partner, or how does that work?
No, you're 100% right. So we had those conversations where sometimes the spouse will bring the spouse on and the credit score is 600 and the primary breadwinner, whoever's making the most money, is 740 plus. If we can take off that 600 credit score and still get qualified, that's what we'll do. Okay. And we tell the clients that, like, look, I know you want your wife on this loan with you, or
and it's not always wife, sometimes it's vice versa.
You know, husband on the loan with you, or, you know, son on the loan with you, get them off. We're gonna take them off. They'll still be on the deed. That way they're an owner of the house, but for the loan purposes, we can save you, you know, half a point in the rate by taking her off for him. And so, yeah, we have those conversations, some refuse, and
Kentucky's a community property state. If you buy a house with your wife, your spouse, regardless of whether or not you're on the loan, which just means you're not financially, you still own half the home. You're just not financially responsible for it. So you're actually you're getting a little bit of a pass, but whatever equity is built over, heaven forbid there's a divorce 5 years later, whatever equity is built over that time, you still have to split it because of the way it is. So it just behooves them to do that. But what we also do is, all right, if the spouse has poor credit, especially now, it's like, all right, in 6 months to a year, we're going to refinance you. So person that's not going on there, here's your steps you need to get done. Over the next year, if you do exactly what we told you, your score will be closer to your spouse's. That way, when you refinance, we can have you on there, because if you do have two borrowers, you get a little better rate. if there's still mortgage insurance is cheaper, and the debt to income ratio is lower because you have two people on there, the rate's a little better. So we're not just kicking them aside, we still want to add value to the realtor partner that, refers
So
to
let's
us.
kind of go back and look at every lever and see which one is full or not full.
Yeah.
Right,
That's why I said it's like a chess game, right? Like you've got to just keep moving the pieces till you finally figure it out. It's a puzzle essentially, right? And I think that's why we both love it, because every deal is not the same, and it's all a puzzle trying to figure out what's the best for the client.
I hate to read, I never read emails. He reads emails and tells me what to do. I love math puzzles. Like if I could sit do that, that's, I love to do, so that's why I do a lot of this stuff. Oh, hello, Miss Vale.
They're like, they never.
Hey, you're coming into the good parts. But yeah, that's what we do. So like I said, a lot of people don't understand how it works. So everybody says, I'm gonna pay all my credit cards off. Can't pay them because you don't have what's called credit usage. Because credit, people will look at it like, all right, you paid it off. All your credit cards say zero. They've said zero for the last 2 months. Why don't you feel responsible enough to use your credit cards? So they take 10, 15 points off your score. So as long as you put $5 on one card each month, your score will be at an optimal level because your credit usage then is below 30%. So they want it below 30, but if you can have it at 1 or 2 and it's constantly at 1 or 2, they'll give you 2 or 3 extra points each month. Like that's how you're going to build your points. If you have an old credit card that has, let's just say, because this happened to me as a young person. One of my first credit cards, there's a $35 annual fee. Well, I paid off my credit card, didn't use it anymore, forgot about the annual fee. But every time the bill came in, I just threw it away.
You paid it off.
Because I paid it off, but I forgot about that $35. Well, after they charged me that next annual fee, the 31st day, my credit score dropped 40 points. Because I was 30 days late on a $35 fee that I forgot about. I've actually lost 2 loans in the process because the client has done something. Not open their bills. Open your credit card bills, whether they're paid off or not. So I got mad, called them, I was like, I've been working on getting my credit score up. I had no idea. I'm sorry. Can I pay it? They were like, yeah, but it's not going to come off your score. I'm like, why? Then I get mad and said, close my card. The person on the phone said, you don't want to do that. I'm like, yeah, I do. They go, no, you don't. This is one of your oldest cards. It'll hurt your score. I go, no, it won't. I'm never going to use it again. Closed it. Dropped another 35 points. I lost like 65, 70 points over $35 because I didn't open the stupid mail. And it took me 6, 7 months to get that back. So it's another thing, like all these little things they want to make sure you're doing. But that credit history that they talk about is your oldest card. If you've had that Discover card from Daytona Beach from 1997, and you still have it, you keep it open because if your next card is 5 years younger than that, you will lose 5 years of credit history and probably lose 20 or 30 points. So that's why we try to get everybody pre-approved as soon as possible. As soon as you start talking to them, that way we can give them all these things. Don't do this, don't do this, don't do this. Because our calculator will actually let them get into the highest score they can and tells us the least amount of money they have to spend.
Let's say I have 2 credit cards, right? And one's my Amex Blue and the other one's the Capital One. They're both, I've had them for probably. But if I wanted to go into the Capital One and say they have a different kind of card, and I decide to change that card to something that's maybe more suitable for my business or whatever, how would that impact?
You leave that card alone. This actually just happened to me because I had a Spark card from 15 years ago. Nobody wants a Spark card. And I haven't used, I know, right? And I haven't used it for 9 years.
Yeah.
So I finally got an email the other day saying we are shutting down your account on this card because they shut it down. It didn't have my score. If I shut it down, the way the creditors look at it is there's something going on in his life that he doesn't feel like he's going to be responsible enough to keep this card open. So we're worried, so we're going to ding the score.
So when I do that, if I talk to Capital One and say, hey, I want this awesome corporate card, but I don't need this other.
You don't tell me you don't need it. You just cut it up.
Can I ask them to shut it down?
Do you have a annual fee on it? No, then just leave it.
Just leave it. Just sit there.
Most majority cards, if you leave it at 0 balance, they're not going to close it out. Now your store cards, stuff like that, they'll automatically close out cards for an activity, but most banks like Capital One, something like that, American Trust, If you leave the card at a zero balance, they're not gonna close it because they know you have that history.
But if they decide to go to, just as long as you.
Is it true that you pay your balance every month? That hurts your credit too?
If you pay, go ahead.
So I'm a credit card payoff person too, get all the points and pay it off every month. The rule of thumb is you want the balance to be under 30% when it reports to the credit bureaus. The problem when someone like me pays off a credit card every month, and originally I was essentially maxing out the card, and when it reports to the credit bureaus, it was showing maxed out, even though I paid it off every month. Because in our world, all we look at is minimum payments. And a lot of people get that confused, like, well, I paid off this credit card. It's like, well, I wish you wouldn't, because that $3,000 and your $25 monthly payment, that $3,000 would have been better sitting in your checking account, and that $25 isn't making a difference. But if you do a payoff every month and your balance is getting real high compared to the limit, call up your bank or whoever has your credit card and say, I need you to increase my limit. Pay off my credit card every month, it's getting down to $5,000 limit, I'm putting $4,000 on it and paying it off every month. I need you to increase it to 15. And more than likely, they may ask like, hey, what's your annual salary? You just tell them.
A lot of times you can do it right on your app.
Right, yeah,
On your
sometimes they don't
app.
even-
I just did that because I have, I just looked, I have 16 credit cards out there in my name. With availability of 88,000, I think they're still on there. Actually, probably more than that, because I just recently have two, but I only use 2 cards. I use American Express for all of my business, and I use Capital One for all of my personal, and I pay them off, and I check that. And I did that because did that. I went onto the app because I was studying my credit score, and anyway, so I went into the app and I asked to increase it, and I had a great payment history, paying in full every month, so they both like increased up, so now even if I use it, I don't have to worry about like, I'm gonna hit that 30%, if I don't pay the payment.
You're so buying my cards, it's kind of right the way they are.
But I don't have any of
Your
them.
credit usage is your total available balance compared to how much you owe. So it's not, if you have a car that has a $5,000 balance, you have $5,000 on that card, that's $60,000 a year. So that's 5% against that 65,000.
It's the total number of credit cards.
Total number of available credit to usage
Across all your cards.
Essentially, they want to see you be.
So you can max out.
I have like all those cards, like I don't ever even use them, like I literally use 2. CJ Maxx, I might use every once in a while, but.
Yeah.
And then like if you check it Karma app, it will show you right on there what your percentage is and how much your usage. So you can check it on there and see exactly where you're at.
Your credit score fluctuates 20 to 30 points every month, just remember. Because it's just when it's reported and then it'll go up and down. And people tell me, spouses will always love to know who's got the higher. If you're over 760, you have a purpose. It just depends on when it's reported, like, or 780, I'm sorry, 780 and above is basically different. So if you're at 790, your spouse is at 797, or if you're at 810, your spouse is 830. Yeah, perfect scores. It's just depending on what time you pull it on your balances are.
So my wife hates it when mine is like 805 or 810, and she's like 794. She's like, what? And I'm like, yeah, you better get it.
So looking at that,
Breaking this down.
Yeah.
this is one of the biggest reasons to get somebody to fill out an application as soon as possible, because this will tell us all the hurdles they're gonna have and allow us to get a roadmap.
Paying stuff off,
Yeah.
getting rid of funds that we could use for other.
That is such a great talking point for the
Yes.
client. That alone to just convey that little nugget of knowledge about why. It gets them in your pocket in your corner immediately as a trusted.
Well, I just had a client refer to me that they were using the realtor sent it to me, he said, I didn't send it to the first person to use because I don't really care for them anymore. Well, they called that person. And they got pre-approved from them, and then 2 weeks later they called me and said, hey, look, we called this person, we don't really like him either. And I was like, wow, they're like, well, we just don't like the way they treated us. And I was like, look, this is how I do things, like my goal is to get you the best deal, let's look at it. So I looked at it. His wife wasn't gonna be on there, and I knew why she wasn't gonna be on there, because of the type of income she had. The husband was on there, he had some credit issues. But I did exactly what we talked about. All right, what's he need to do? I'm like, So when I called, I said, hey, call me. I want to do your pre-approval, but I need these bits of information. And let's go on the phone. So I called him on the phone. They called me, we started talking. I was like, hey, this. They're like, yeah, this. I'm like, yeah. And I said, well, you got this on your credit. He needs to be taken off as this authorized user and he needs to do this. And I was like, if you, and in 3 months, I can get you pre-qualified now, but your rate's gonna be astronomical. If you just do these couple of things that I told you to do over the next couple of months while you're looking for a house, by the time you're ready to buy, I can save you at least $3.5 million. And they said, it's funny you say that. The other lender said there was no need to do that. And I was like, well, there's like no need to do that. And I was like, that's a lender that doesn't want to go through the headache of doing it, because once they do that, then they have to send us statements. We then have to send it to the credit. We have to go through this process and do it. And then in this guy's mind was, hey, they can buy as it is, and I don't care what the rate is. I don't care that their rate's going to have. I'm just going to tell them I can get it done now, get it done, moving on your pace. I report government housing. I like getting paid up, but I also like not to screw people over. So if I can save somebody $30,000 on their loan or anything else, I'm gonna wait 2 months to get my paycheck to make sure, because those people are always gonna remember that. Come back to me, come back to the realtor that did that. So that's why we like to do those things, is to look at it and see, because it can save them so much money by just doing a little bit of work.
Yeah.
So this is why this
A
is.
lot of these online lenders especially are just very transactional, and that's all they care about, is the transaction happening. Where we just kind of take a little deeper look at everything, the whole picture, and see, okay, if we're not ready now, how do we get you ready? And then, send it back to you guys in 4 or 5 months, and say, hey, you remember this client you sent me? We got them ready now, they're pre-approved, let's get in the house.
And you had to stay on top too. I had another one of the realtors text me, and she was like, are you still working with such and such? And I was like, and I looked at my notes and I go, I talked to them 3 weeks ago, and I said that they needed to do 3 things to get their score up in the next 90 days to save them from getting an 8.5% interest rate with spending $5,000 to get that 8.5%. That if they did these things in 90 days, their rate would be so much cheaper, so much better. I think it's better now. And I mean, I could probably get them done now, but it would still be kind of hit or miss. Well, she texted me back and said, well, they got a pre-approval letter from somebody else. I said, well, find out who it is. Find out if they got a closing cost worksheet. And have them send it, that way we can look and see what they're charging for. Because what a lot of these transaction people do is we get paid 100% commission like you guys. Some of these other places, they're 9 to 5. They get bonuses on credit, they get bonuses for getting credit. Then they'll take them out shopping, even though they're not. They get documents that prove their income. They take them out shopping. The realtors takes them out shopping, spend money on inspections, spend money on appraisals, $1,000 in it. Then the lawyer says, oh, your income's not what you said it was. You're denied. They still get paid. Client's out $1,000. You're out. We are like, no, that's not gonna happen. So I had her do that. I looked up the name. Well, because she was like, hey, I'm in Keeneland. I'll call in when I get done. I was like, that's fine. I did legwork for her. So I looked at this lender that I'd never heard of before, who had a 1.5-star review, total review out of 60 reviews. They were all 1 stars, except for obviously 5 or 6 plants of 5 stars in there. Then I looked at their Better Business reviews. And what I told her was, they didn't do this, they didn't. I said, I'm assuming they didn't do this, I'm assuming they did do this, I'm assuming that the rates would be astronomical. But they just told them, you can get a house. They didn't tell them how much it was going to cost them to get this house. So I sent her all that information. It's like, please get a closing cost worksheet and let me look at it. I was like, because they're going to waste thousands of dollars, or they're going to waste thousands of dollars to buy a house that they shouldn't be buying, or they're going to lose just $1,000, $1,500.
Because have you heard, oh, they never gave me a worksheet. I don't know.
Oh, yeah.
I get that all the
56%
time.
time,
I'm gonna work with this lender, great, where's your worksheet, so we know what we're doing. Oh, they didn't give me, how do you know what you're buying?
I send the worksheet before I send the letter. Actually, we make it together. Because we have just a couple buttons we hit to hit them, and then we email it together. Worksheet's the first thing I do. It's the first thing I do, put it in the file, then I do the letter, and then I send them the pre-approval letter with their stuff. Say, here's a worksheet, it's cash to close. We overestimated it. Hopefully it's gonna be less than that, say 1,500. Yeah.
It's just, for us, it blows our minds, and maybe for you guys too, right? Like, you'll go to the doctor and do the second opinion. Wait, okay. No, I Like if I need a filling for a tooth or something, it's, oh, you need 3 fillings, go check somebody out. Somebody who's willing to spend $500,000+ on a house will not go get a second opinion. They'll just sometimes take that first lender and just go. It's like, you're about to dump 500 grand. I know it's not all your money, but you're gonna invest into a $500,000 house and you don't want a second opinion. Like, that just blows my mind.
Credit's the big thing. Next thing is we like to look and see their affordability. Because rates have gone up so much, looking to see how much you can afford, and know your ideal price, down payment, and monthly payment before you go looking. So on this $170,000 house on these clients that I just said for this neighborhoods, rates have gone up. Even from where I quoted, on a $170,000 house, they're paying $100 in 2 weeks. You know, and on that $170,000 house, I think it was like $2,300. Like there is no more houses for under $2,000 a month right now with the way rates are. So you get that a lot of first time home buyers or people buying a house still think, okay, I paid $1,400 for this $200,000 house and $300,000. You're talking about $3,000. So having them talk to us will give them the idea of actually what the house payment is going to be and their affordability. But also gets them in our system, because when rates go up a point like they've gone up in the last 3 weeks, we can then know who's close on the debt to income ratio, and then call the realtor back and be like, hey, remember when you said they go buy a $300,000 house? It's 265 now. So don't show them anything over 265 until these rates go back down. That way you're not out there wasting time, guys, finding, showing houses that they're not gonna be able to afford at that time. So the affordability is a big thing, getting down and making sure everybody kind of knows what you should be looking for.
All time worst affordability.
Yeah. And then cash to close, you know, get an accurate estimate on how, you know, that number we talk about. Cash to close is it, like it's everything together. So we want to know what that's going to be. We want to know where it's going to come from. That we can plan on shortfall. If you don't have enough, then you can start planning on where that other part's going to come from, or we can start looking into it for you on where you can do it. Because the money has to be seasoned. Does everybody know what seasoned money is? Money has to be in the bank for 60 days. You know, it can't be what we call mattress money. You can't have 10,000 under a mattress. Pull it out, here you go. It can't be cash. We find gifts from family members. We can find, you know, 401ks, et cetera. The et cetera is our job. And this is what I tell my clients: I'm not a scary banker that makes a decision if you get this house. My job is to get you this loan. I only get paid if I get you this loan. So my job is to know how to present this loan package to the underwriters to approve it, to get it done. So our job is to know how to get around it, how to get a gift that's not really a gift. It's just a change of money.
Is it a lot better for a lot of, if it's coming from like a gift, to leave it in that other account and then have it wired? We don't want to move it around.
You don't want to move it around, because anytime money's moved, there's a paper trail. Right. So you got to prove where that money went, where it came out of, where it went, what day, make sure it matches up. But if it's coming out of this donor's account, then we just get a gift letter, have them sign it, and then I think conventional loan.
Conventional loan, you can just have them write a check to title.
Yeah,
Be done.
and be done. That's it.
FHA, we gotta be documents.
You gotta show that they actually had the money in the bank. So I just had somebody going out of his HELOC for his brother, and then he wired it, but because he still pulled it up a HELOC, we had to show where his HELOC was, the day that money came out. Then that was transferred into the checking account, and then that wire came out that checking. So those are all the things that are approved. So that's our job, is to get all the stuff ready to make the underwriters happy to. So that's why we want to make sure we get all this information up front. That way, my old boss used to call it taking sand to the beach. You never take sand to the beach, right? You just it's there. So we only want to present to the underwriters and processors as little as possible, because the more information you get, the more they can scrutinize, or the questions they ask. So our job is to get everything from. So then if we have time to make sure everybody's cleaner, then the file is, especially if we can do this and do the step ahead program, get them approved. Then all we have to do is, if it takes another 2 or 3 weeks to find a house, we just get new updated bank statements and updated pay stubs. Everything else is already approved. So then we're still just here. It takes 5 minutes to get your pay stubs, send it up within 24 hours. It's not paid pre-approval. You can still go into contract, because we know If it's the same company, it's the same pay stub, it's the same stuff, it's fine. But we also know if you change jobs at that time, or quit your job, or done whatever, or retired, we're retired.
Retired, that's what I was just getting ready to ask, because I just retired, so what do you do, like, so say when I want to go out and buy a new house, which we're not gonna do, but. So do you just show proof of funds in your 401k? I mean, how do you? Like, when somebody isn't working anymore, how do you all see where the money is?
So if you have enough funds in your retirement account to make 36 payments, and then you show that you're gonna have it all, you just have to set that as being a constant deposit into your checking account. You set it up that over the next 36 months, coming out of my investment accounts or whatever else, this amount of money is gonna be deposited each month, then count that as income. But then it has to be enough to cover your debt to make your debt to income ratio.
Would that vary if it's gonna be owner occupied or an investment property? Because if it's investment property, it's already income producing, that would help offset that.
Right, yeah, you can use that income, but that's become more difficult after COVID too, you know, when you certain percentages of the where it has to. You know, you gotta get your tax returns to show how much you've actually claimed as income before. You gotta show the lease amount, and you can take 75% of
The
rental.
75% of the rent or average rent, whichever is cheaper. And use that to offset the payment for the new house you're trying to invest and buy.
Oh, and for those starting next month on the 20th, Fannie and Freddie have made it a little easier to buy multi-units, up to 4 units, 2, 3, and 4 units. Can now takes as little as 5% down instead of 15% down. So they still, the rate's a little higher on investment properties than second homes.
Yes.
But you can buy an individual home now, because I bought a duplex 8-9 years ago. I own FHA. FHA can do 3.5% down with a unit on their occupancy. So I bought it 3.5%. I've had it since then. My favorite child lives next door for the last 4 years, but I've refinanced the conventional. So once I got enough equity to do conventional, do it that way, because it used to be conventional, you'd have 15% down on the down multi. So as of 20, the next month will be 5%. So make it easier for you to do it that way. But yeah, getting everything season go. This next one, this is the last one, and it's a big one right now. It's interest rates are too high. So, like I said, when we first started talking, we look at your entire financial situation, because the money you have needs to be allocated to the loan and in the appropriate places to maximize your buy. And what we look at is your amount of equity in your current home, what's your total monthly cash output with all of your bills. Not all of your bills, all of your bills on your credit card payment, credit cards, installments, mortgages, HELOCs, things like that. What are your high interest debts? In 2022, the average credit card APR for a person with good credit was 23.5. The average APR for a new auto was 6%. Used car was 10.26%. And I think that's gone up this year. Like the car loans have even gone up. Average interest for a personal loan was 9.41%. And student loans are set to resume June 30th, first payment due this month, and the average student loan is 5.8%. So what I'm about to show you is an actual credit report from one of my clients. It's a guy that I've known forever, and I love this kid, and I call him a kid because he's a younger guy, and I try to pre-approve him twice. Each time I just, come on, man. He has so much debt at such an early age, and it's such unsecured debt. So I only took the top half of his credit report for this example I'm getting ready to show you. So interest rates are too high. Yes, they are. But some people have to buy, and some people may find it better to buy if they have a lot of high interest credit cards or in debt in general. And this is kind of what we looked at, the scenario. So let's say that clients have a $250,000 mortgage that they refinanced to a 20-year mortgage during COVID. They get 3% interest. Their monthly mortgage payment is $1,747.68 a month. And they have $150,000 in equity. If they sell it, $150,000. Let's just say that they have a big house, they want to downsize to a ranch. They've got additionally monthly debt that follows. This is the actual debt that my buddy had. Car loan, 12% interest, balance of $13,736, payment of $303 a month. It's not too bad. Credit card, 24% interest, $11,351, $381 a month. Secured loan, because he had credit cards before that he validated. It's a secured loan, $8,258 for $251 a month. Another credit card, $8,000, $378 a month. Another credit card, $2,000 a month, $102. Yes, yes. I don't even get into the student loans. Like these are just debts. So that's a total debt of $43,437 in high interest credit cards and loans. That's a monthly payment of $1,415 a month. So if you combine that with the mortgage, $3,162 a month. So their total monthly output for their debts in homes, $3,162. And the way that everybody looks at it right now is, yeah, interest rates are high. I don't want to buy a house because that thing's going to transfer over. So yeah, if you use all of your equity to buy a $500,000 house, let's say you're going to buy a $500,000 ranch, you downsize. Your house payment on 6.5%, which the rates are higher right now. With all your closing costs, $500,000, putting 28% down, $150,000 cash to close with everything. Your monthly house payment is $2,750. Your other bills are still $1,450 a month. So your monthly output, it has gone up $1,000 a month. Obviously, nobody wants to buy a house now if you're going to go up $1,000 a month. Mortgage interest is higher, and you're still paying high interest debt. But there are those clients out there that have this debt or they need to do cash out refi, and they need to do certain things. This is where we look at their money. And this is kind of an outlandish one, but we do this with everything to see it. This person has $150,000 to use. So let's look at the best way to use $150,000. So instead of putting down 28%, we'll put down 18%. Okay. So if you're only using $100,000, $100,850 cash to close and buy the same house, same interest rate. What you say is, well, it's under 20%. It means they got mortgage insurance. What a lot of people don't understand is mortgage insurance for somebody with decent credit, with 18%, it's not that much. You're talking $9 or $10, $12 a month, but you can also pay for it off up front. So this actually factors in paying off your mortgage insurance up front. So you paid off your mortgage insurance, you still use $108,000. Your monthly house payment has gone up to $3,119, which is a lot more than you're paying for the $1,700. But now you've got $43,437 of that $150,000 to pay off all that secured debt or unsecured debt of $1,450. Your monthly output has now gone down $43 a month. You got a brand new house, all of your credit cards are paid off, cars paid off. You still have $5,700 left over to pay for movers, pay for some new furniture, whatever you want. But you've allocated your money correctly. So we do that a lot. Somebody calls me up and says, I did with my sister. This other bank said that they can give me this interest rate. And they can do this and they can do this. And I go, well, that interest rate is better than I can do today. Get a closing cost worksheet. She's like, what's that? It's Friday. Yeah. It's Friday at 5:30. My brother and sister-in-law giving me grief about being too high on interest rates when they have no idea what they're actually talking about. I said, text them right now and ask you your closing cost worksheet. Why? I go, just see when they get it to you. I said, I'll have you one in 45 minutes. 45 minutes later, they had mine. I was like, now this is a base. Show me theirs. So Monday at 10:30, when they sent it, So I called my brother-in-law and I said, hey, I will be in E-Town tomorrow and I will have 3 different options. So when I looked at that closing cost worksheet, this other banker, they were offering them 7.25. My rate at that day was 3.75. We're not paying for 8 points for the units. But they had my sister bringing $140,000 to close. My 3 options, and after 2.5 hours of breaking them down, my sister, she looks at me, she goes, how am I bringing $80,000 to closing and my interest rate is 6.25 and my payment's $400 less a month? I go, because you got a smart brother. So what I did was I took that money, I asked them, and they said, what's the best deal? Because I gave them a couple other options. They said, what's the best deal? And I go, what means the most to you? Like, what do you mean? I go, what is your need in life? Well, when she was 16 years, my sister is 16 years younger than I. So I'm 32 and she's 16. She gets her first paycheck. And she wants to take me to lunch to talk about how to be an adult. She goes, what do I need to do to be an adult? It's the only time she's ever listened to my life. Her husband loves me for it. I said, you live at home for free with mom. You do this, you do this, you do that. You make this amount of money. 20% of everything you make goes into savings from the very first paycheck. And if you do that, you will never have to worry about money. Fast forward 14 years. She goes, I have $100,000 in the bank. Everything's paid for, like, bills are on time. She's very frugal. She has $100,000 in the bank. And she said, I don't want that to go away. That's for the kids. I said, well, the amount of money you're getting from your house to put $140,000 down, you're gonna have to take $28,000 to $30,000 out of your savings. Here comes a chunk. The way I'm doing it is, you take the money that you're getting from this house, put down 15%. We're gonna pay your mortgage insurance off front. We're gonna take this chunk of money. We're gonna buy that rate down from 7.375 to 6.25. You still got $28,000 left over of money you still don't have to touch in your savings. It's money coming from your house. You're going to pay off your new car, which is $500. So now you're saving. You're not using any of the money. You can actually, I think she had $8,000 left over in one of the scenarios to put into savings and pay off the car and have it. So that's what we do. Is if somebody says, "Hey, I want to put down 25%," I go, "Let's look at it. 25% might be fine." Put 15% down, paying off high interest, this, that.
I did that with my sister. She's completely opposite. She's not good at saving money. And when her and her husband relocated, they were selling their house and looking in a different area, not near here. So I wasn't telling them, but they couldn't find anything they wanted. And I said, why don't you take the money from selling your house, pay off your car with $600 a month? So now they were able to afford the house that they wanted, that they couldn't afford before because of the payment. So, yeah, so that's always a good thing to kind of get in. Sometimes most lenders are not as good as you are, to be able to, I mean, it's honest, most of them aren't, they're not as good to do that. And I mean, as realtors, there's a lot of times where I'll suggest that, I'll bring that up, like, why don't we take some of the money and pay off some credit cards or pay your car down or something like that, and then you have that extra money going towards the house.
You don't even have to, like, it's not even to use it to buy more of a house, it's just to be more comfortable.
Right.
And it's to make sure that the loan goes, because like we said, if your debt to income ratio is right at the max, the tip top max, and the rate goes up a 0.5 point, you can no longer get there. But if we can allocate all our money the proper way and just say, if they say they wanted 450, but we put their money in the right places, they actually can afford 525. I'm not going to tell them they can afford 525 until I'm going to tell Vanessa they're very comfortable. This is easy to do. Go show them. Now when they come back like, we really can't find anything else. What's it look like if we can go to here? Then we move them up, because it's not about maximizing. For us, it's not about maximizing our income, our commission. It's about doing a good job, getting the deal done, and having those people come back to us. And doing it that way, it does, because I mean, car payments are now, they're no longer $200 or $300. I mean, they're $500 to $1,000.
Average price of a car in this country is like over $40,000.
Oh, yeah.
They're going to 8-year loans.
Yeah.
They're going to 8-year loans. And I've heard that they may go to 10-year loans on a car. I mean, I love trucks. I'm gonna spend $120,000.
Yeah.
That's the thing, they're not. You make it last long enough to where you get enough money and constantly stay in there.
Oh, my car lived at the end of its life and I'm ready to buy it, but I'm also doing a $1 billion renovation now. So all of my cash is allotted.
I
for something
refuse
else.
to do one, because mine,
So-
you need to be aggressive, I'm like,
It's
I don't.
drive my little Hyundai to the ground, but it's, my son's gonna get it in a few years and he's like, why is this my car?
What they need to teach schools is what Vanessa said, but also to understand having a nice car is great. Yeah. But especially right now with first time home buyers, when I have somebody call me and say I'm a first time home buyer, I get sad because I know how difficult it's going to be to get them a home. Because there's no more $195,000 with 4% interest and $1,600 payment.
And sell prices. And crap.
Exactly.
100,000 right per.
So everything is higher now. But what these people are doing to get out of college, they're buying that car for $600 to get that first real job, and they're going to buy a nice car. Well, that $600 car payment is now made it even harder to qualify for a home. So with any teacher was like, that crappy car, get a lease where you have 2 or 3 hundred payment till you get your house.
I had a listing under contract, and the buyer, had sold a house and had the money from it, and she went out and bought a car and did all these things after she sold the house before we closed on the new house, and almost blew up the entire deal because she was getting.
Is that the deal you just had?
I had
He retired, she almost bought a new car.
I had a deal that I've never seen anything like it. So I did all the things I did, right? She decided to go to a different bank because they smoke and mirrors. Well, a week and a half into it, she calls me, she's like, can you save this? I gotta come close in 3 weeks. I said, send me your stuff. And they look at it and I was like, yeah, I need you closed in 3 weeks. Got her cleared to close in 19 days. We sent in the request for the final verification of employment. She retired. So we couldn't count her in. So then I take the next week and a half looking at her retirement information, looking at this, looking at that, see if we can save her. Can't. Well, in that week and a half, when I said, hey, you got unretired. So she went back to work unretired. Well, she was set to retire at a certain point. So she just canceled retirement. Go back in to clear to close again. We have to pull what's called LQI, but basically just pull to see if you have any debts. She ran at $5,000 on her credit cards.
Doing what?
The QVC. QVC, and I was like, wait.
You have 3 left. You've got to order.
You see on Amazon at 12:30 at night, whenever you're groggy, you're like, I'm gonna buy that. You gotta watch TV to buy stuff on QVC. I guess you do. So her credit score dropped. So I call her up and I go, so we were getting ready to clear to close it for the second time. And we did your LQI, and did you charge $5,000? And she goes, maybe. And I go, well, your credit score just shot 40 points and you no longer qualify for this loan. She goes, okay. Like she understood, like it was okay. And I was like, but I've already, if there's an issue on one of my loans, I have an answer and a backup answer on how we're gonna fix it. Or the first thing is, it's not fixable. So I was like, we're gonna switch it to FHA. But we have to do another appraisal because we did a conventional appraisal the first time. So we're going through that. As we go through that, we realize it's a 180-day rule. 180-day rule, I don't know if you know, on a flip is if you're selling it for more than 20% of what you paid for it, which this is 100%, and it's inside 180 days, you have to have 2 appraisals. Well, when I found this out was on the 183rd day. So what I then did was I made a whole new loan.
Now, is that the same on conventional, or is that
That's just FHA.
Right, so I have one right.
I started a whole new loan. So we didn't have to use the 180-day because at that point, we needed a new contract that was signed on the 182nd day. So I move into that. Get it back. The appraiser comes back and goes, crawl space is too much, it's too short. Well, it's a flipper who has his real estate license, who's a stage trooper, who's never done this before. So my agent, who this client had went and looked at a FSBO, was only doing this for $1,000. And she said, Brad, I don't care if this closes or not. I got it. So I handled all the listing calls from the state troopers. Like, what's going on? I was like, you ever heard of 180-day rule? He's like, no. I go, I know you're a new flipper. You're gonna have to understand these rules. And I was like, and this appraiser's come back out. I go, I need you to dig that thing out. You gotta make sure this is all done, or it's not gonna close. First time we got to clear close was, I say, 18 days, 21 days, something like that.
Yeah.
We're at day 45. Finally get everything done. Then all of a sudden, the guy told her she was getting a gift, that the gift couldn't be cash from her brother. It was cash from her brother. So then we had to like move the gift around. She had sold a piece of land to her mom. Got to end up doing that. Get it all done after like 50 some days.
See, these are the stories people need to hear because they don't understand all the behind the scenes.
Right, so.
They think, oh, what's the praise, or it's this or that.
So I called the agent, right? Called the agent, was like, clear close, bring close on Friday, blah. She goes, I can't wait to see you. I have something to tell you. And I was like, oh, awesome. Go to closing, everybody sign. She's just oblivious, just like, oh, no, sign the stuff. She leaves. the agent I've known since college, and she was like, I'm gonna tell you something, you're not gonna believe it. But she goes, we went through the final walkthrough last night. And she was like a little 9-year-old kid on a phone, just playing with her phone. But she brought one of her friends, and her friend was asking all the questions. Was this done? Was this done? Was this done? And she's sitting over there like, shopping. She's shopping for stuff. So they get done with it. They walk outside, and she's looking at my client's looking at something. My friend's like, does she know how much she has to bring in the disposal? She's like, Brad's already told her that she's cashier's check, this company, this not. She's like, oh. I've had to let her know about the cashier check. She's like, no, it's cashier. She's like, no, you don't understand. She's like a child when it comes to stuff like this. She goes, I had to talk her out of buying a brand new car the day before yesterday. The agent was like, what? She goes, she was at the Nissan dealership getting ready to buy a brand new SUV. And I had to tell her, you cannot do this. You have already been through all these things with this loan. If you buy this car, you will not get this loan. And she goes, I finally talked her out of it. Like that's all.
I mean, that's just as proof that we're dealing with absolute morons sometimes, like.
He used that paper, just so you know.
Yeah.
Well, I think a lot of times people like, especially first time home buyers, that they think like, and I've used this scenario, I was telling people, when you go shopping for a car, you go and you find the car that you like, and then you go sit down with the finance manager and talk about the car. The house is, you wanna talk to the lender first, get that set up, make sure you know the budget and where you're gonna, the type of loan and everything else that's different, and then you go out shopping. But a lot of times people will tell, like, when you first talk to them, they'll say, well, I just bought a car, I know I got great credit, and blah, 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 and I have to explain to them, well, what they pull and what the lender looks at is two different things. So it's best, let's go ahead and get you hooked up with the lender, so they can really look at the big picture of everything and see what the best financial option is for you. It's just that educating them, because people, our society does not do a good job.
That's a good chance to be that financial, that wealth building, you know, ally to help them start to put some of those pieces together that they maybe have never had anyone explain it to
Right.
them.
That's the thing,
And
that's something.
there's some simple things, but once you get it, you're like, oh, okay.
They think buying a house is like buying a car.
Yeah.
You just go in and you some paperwork, you're not, they don't realize all the behind the scenes things that makes it work,
And
so.
the closing cost worksheet is so vital, I feel like, it making such a smoother transaction too. And if you talk to the client, you ask them about that, they don't know what that is, that's terrible, cinema. Because I had a client who called me and they're like, we see this house, we wanna look at it today, get us pre-approved for this amount. Well, I did, and had I not sent them the closing cost worksheet, they probably would have put in an offer and went on. Then I told them their payment, and they're like, oh, that's a little too expensive for us. I was like, well, what do you want to pay? Cause I can get you approved for more even based on your income. And if this is the house you want, then this is what it's gonna cost you. Well, they were like, well, I want a $1,300 payment. I was like, well, that $200-something thousand house that you like is now $140,000. Once you add taxes, insurance, all that. And they're like, oh, well, I can't find much of that. No, you can't. So unless you want some shed from Lowe's, that's about all you're gonna get.
The two biggest, I think the two biggest things we as a need to tell them are the lender you talk to, like I said, is not the scary bank. They're an ally that's going to help you with this process.
Right.
It is a process that is going to be done. People are like, well, why do I have to do all this stuff? Well, you're giving me $10,000 for a $400,000 house. Like, so you're going to get basically $390,000. So don't you think you have to have a little bit of skin in the game and just give me some documents and, you know, and to do those things? So, you know, that's the big thing. It's like, just trust them, tell them everything, be honest. You know, don't hide anything, because we don't care. Like, if you tell something like, we're not gonna say that, we're gonna say that, so don't do this or don't do that. Like, that's what we want to do. But the other thing I do is, once we are done, your job for the next 30 days, because this is how long it takes, is 30 days. 30 days for reasons that seem like a couple days, like you just fly by me. For you, it's gonna take forever. I go, your job for the next 30 days is to be bored. Okay? You go to work and you go home. And if you want to do something, you text Brad and say, hey, Brad, can I do this? If you want to go on vacation, ask me. I get to make your decisions for the next 30 days.
That's so true.
I'm real nice. Like, I want you to do all the things you can do that will not affect this small company. If you tell me you're going to go to Best Buy and buy all brand new appliances, I'm gonna take
Don't
that.
even let them run your credit. I had one of us fall apart just because he went shopping for furniture and had his credit pulled. And the lender told me,
10%
he was like, it's
Yeah.
fine. So like, I told him, that I'm like, don't have your credit pull, you can go window shop, but don't even a salesperson comes up to you, be like, no, I'll come back after my close, it's like, you cannot do anything. Unless you have the people that have perfect credit and income and you don't have to worry about it, but I always tell people, like, if you talk to a lender before you do anything.
Yeah, and that's because that's the thing, like, because each one's individual. And they're different.
Every
So if you
scenario
text
is
me,
different.
if I know you have $130,000 in the bank, and you wanna go to $5,000 on fracture, you're gonna take that. Go by 6,000, whatever, that's fine. But those ones that are like right on the cusp or barely had it, it's like, no, I'm sorry. I know you really wanna do this, and I know you wanna save that 10% because you go open that car or they have this sale, but guess what? That sale's gonna be the same thing next week.
Exactly.
Cause I was about to grab my refrigerator. I gotta get, cause I gotta put my homeowner's warranty. And they were dragging their feet on getting the information. I was like, oh man, the sales around. I was like, wait a second, it's gonna be the same thing next week.
Right.
And the sale is just again, so. That's what we have to educate them. It's like, we're advocates. Our job is to get you this house, is to get you the best deal. You have to be honest, you have to be communicative. And just be more.
And we were talking about this morning, you know, people, right now, it seems like buyers are so tight with the ratios anymore. That there's not a lot of room to swing, and by doing something stupid like going and putting $3,000 on a credit card and dropping the rate 10 points. Has more impact than it used to back in the day. And that 10-point swing in your credit score, it causes a 0.25% swing in the rate, which now throws your UTI out of whack, and you just throw away getting a new house. And it's just, people are so tight at the rigid. You got to be careful.
But that's it. I mean, so the next one was just kind of over, people are normally in a house for 4 years. So if this guy paid credit cards for 4 years, he would spend another $15,000 in interest. So he say by paying those things off up front, you save $15,000 in interest on top of it. So yeah, you're paying a little bit more, but you're gonna be in this house for 30 years. And by that time, in the next year and a half, 2 years, one of the Brad's gonna buy it, hey, great for 5.5 years, and get you down. So you're saving that money at that time.
So you think, 2025 spring, you're gonna pay 5.5?